big data to be released tomorrow. We get non-farm payrolls, we get unemployment, we get a few other bits and pieces in there. We've gotten some information today and just yesterday. My belief, the market's ahead of itself. Interest rates will remain higher for longer. I'm front running tomorrow's number. I've bought some options. I've got a little theta in there. I got some time. None of them are going to expire tomorrow. If you go through the list of Treasury yield ETFs, there's a few out there. A lot of them have expiration dates for next week and then a month later. Nonetheless, I have positions. I put it on. I have a small position that say TLT stock would move upward a bit if we got some positive numbers. That upward a bit would make my entire position profitable. If not, what I'm really betting, and all the premium that I paid on these options would be covered in that first call if I'm wrong on that. But my big bet is the puts. I bought a bunch of TLT puts because I basically believe that the Treasury yields are getting ahead of themselves. The S&P 500, SPY stock, for those of you who like to trade that, including myself, again, ahead of itself. Interest rates are going to remain higher for longer. We're probably going to get that solidified yet again tomorrow with the data points we'll get from non-farm payrolls and unemployment. But I'm not just looking at, say, inflation with CPI or PCE deflator. I'm also looking at the money supply. And I'm looking at historical numbers as well. The Federal Reserve back in the early 1990s kept interest rates high for a very long time. The M2 money supply during that period, flatline for 6-7 years. Federal Reserve pushed the money supply up extraordinarily in 2020. They need to shrink it and then flatline it for a while so we can get back on track on a trendline basis. Because of that, I expect that the markets will move significantly tomorrow, and I'll probably do pretty well one way or the other. Again, I've given myself some leeway that if I'm wrong on that bigger position, I'll still probably pay for my losses, and then I'll immediately get out of the trade. So I'm okay. I think I'm going to do pretty well tomorrow regardless. I'll at least probably break even, then I'll get out, or I'll do very well. Let's jump in. I want to break down some of the employment numbers we've seen so far today and what I think might happen tomorrow and throughout the rest of the month of December. Let's jump in. For those of you who just joined me for the first time finding my channel, I know these TLT stocks are pretty popular on my channel. Thanks so much for stopping by to check it out. Make sure to hit that like and follow button. First and foremost, I'm D.H. Taylor. I'm an economist, been working in the markets professionally since the 1990s. And what I do is I break down the economy and show how economic indicators will affect aspects of the stock market. So you may want to factor this in with your stock market analysis. We are looking at initial claims. Initial claims kind of popped up a little bit. One thing to keep in mind, because I'm about to show you continuing claims, this is initial claims for this period of time. Continuing claims would be 1 week behind. So this is what happened this week. The next chart, we'll move forward. Continuing claims was from last week because it's continuing. It's not happening right now. There's a slight delay. What are we learning here? All right. A couple things. First off, continuing claims have been moving up slightly, and they're elevated a little bit versus, say, going backwards a little bit just towards the beginning of the year and all through last summer or summer 2022. Effectively, what we're seeing is initial claims. That first chart I showed you is starting to pop up a little bit, but basically it's been pretty steady. So people lose their job at a consistent rate. Okay, but what we're finding when we look at continuing claims is once they lose that job, they're not necessarily getting a job right away, and that could be interesting. Here is non-farm payrolls over the past couple of quarters, and as you can see, we've been fairly kind of stuck in a range. We had a stellar January 2023, of course. Going back a couple months, you can see some pops here and there, but market is expecting anywhere from, say, 160 to 180 new jobs created. That's still pretty firm. It's still pretty trendline. And this is one of the things that if the economic indicator hits right in that center spot, say 170, expectations I've seen for 160 to 180. Let's say they hit 170. That basically means that the job market is still pretty strong, steady, not robust, but definitely not slowing down too much. That could put the pause that I'm looking for in Treasury yields. Again, I feel that it's moving too far, too fast, too early. Next is job openings. We got JOLTS on, Wednesday? JOLTS is showing that there's less and less job openings available right now. So employers, again, we go back to initial claims, pretty steady. Some people are losing their jobs, but continuing claims are starting to creep up a little bit. So once you lose a job, you have a less likelihood to actually get another job coming up. Job openings tells us one of two things. It's either that any job openings are getting filled right away, or there's just not as many job openings, which mean that the economy employers are not hiring as much moving forward. But we see, here's the U.S. 10-year Treasury yield 4-hour chart. And as you can see, it's been sliding steadily lower towards the end of October. And this was kind of a bit of an anomaly. Yields pushed up rapidly. No one really hit the hammer on the head there with exactly the reason why. That during October, there was a big push higher in yield. Since then, all through November, it's reversed. The stock market did exactly the opposite. All through October, sold off, then has reversed and is hitting some pretty decent highs right now because of the reversal in the yields. Now, my take on that is simple. You're looking at yields right now, the 10-year, that's the benchmark. All right, this is where you begin your analysis for stock market analysis and ask the question, should I buy this stock for a long-term value investment? Well, you can get 4.11% yield over the next 10 years locked in from the U.S. federal government if you bought a U.S. Treasury note, the 10-year Treasury note. When you look at a lot of the yield, you could get the next 4 quarters divided over top of the current stock price. A lot of stocks are only yielding, say, 2.5 to 3 to 3.25%. So if you have 4.11%, why would you buy a stock that potentially is yielding much lower in an economy that the Federal Reserve is mostly trying to restrict somewhat, if at all, trying to get inflation back down to 2%? So you may see the stock markets begin to sell off simply because the yield differential between what you're getting out of stocks with almost zero or negative premium for the risk you're taking on versus the 4.11 you can get out of the 10-year right now. Moving forward a little bit, this is the 20-year Treasury yield. This is a longer-term chart. I wanted to kind of look at this. You could see how all through the summer and into October, there was a big move higher in yield. We've kind of backed down. The 10 and the 20 are pretty much close to each other. There is a little differentiation there. The 10 was at 4.11, the 20 is at 4.39, which basically the market is saying we believe interest rates will be higher 20 years from now versus 10 years now, because there's a lot more time. You just never know what's going to happen 20 years, more so than 10. All right. Again, this sell-off in yield, I see this as being a little too much too far. Interest rates will remain higher for longer. Therefore, what I have done is I've sold calls on some of the ETFs, bought some calls on some of the ETFs for, say, TLT, TMF, those kinds of stocks, and I kind of got a basket. I was looking at my delta and the gamma, how much delta would move if there is a $1 price movement in each of the underlying. highly quantitative when I kind of look at that kind of stuff. My calls are small. If I'm wrong, if yield falls lower on the Treasury note, modestly, I'll probably make up. I'll be profitable in those calls, but I'll probably make up a decent size amount of what I lost in the puts. The put position that I have on for TLT, TMF, UBH stock, I bought some puts on UBH stock. There's others out there. Feel free to look at the database. I mean, there's like 3 pages of these these ETFs on the Treasury notes. I'm looking for this market to turn right back around over the course of, say, the next 10 days, quickly, sharply. And I expect I'll probably do okay. I think the market is getting ahead of itself. I don't think inflation is near where it needs to be with regard to interest rate yields. And I think we're getting a good reevaluation starting tomorrow with the jobs report. Jobs is a lagging indicator. So it may be a couple more months before we start seeing dramatic moves lower. But we could start seeing dramatic moves lower in employment starting tomorrow, and I'm covered for that. But my bigger position is simply this: the market's ahead of itself, too far. And because of that, I'll probably do pretty well tomorrow. Make sure you hit that like and follow button if this is kind of content you're looking for. Appreciate all the comments in the bottom. We'll see you in the next video.